a range. Right before the real upward move, Wyckoff observed a move called the spring, a quick spike below the range that shakes out early buyers. In modern smart money trading, we call this move a liquidity sweep because it grabs the liquidity below the range and then reverses sharply. Once that sweep is complete, price breaks out of the range and begins the uptrend. As price pushes higher, the trend is supported by liquidity runs, institutional continuation patterns. For example, price breaks above a resistance. That resistance becomes new support. Price pulls back, briefly dips below it, and then closes back above. This is a bullish liquidity run, and it provides the fuel needed for the uptrend to continue. You will see this pattern repeat at multiple levels as the structure continues to build higher highs and higher lows. Eventually, the uptrend slows and the market forms another range. Wyckoff called this the distribution phase, where institutions take profits and prepare for a reversal. Before the downtrend begins, Wyckoff identified a move called the upthrust, which is simply the opposite of the spring. In modern terms, this is another liquidity sweep, but this time, the sweep occurs above the range. This trap convinces buyers the market will continue rising, but institutions use their orders to sell into that buying pressure. After the sweep, price breaks down and the downtrend begins. During the bearish phase, liquidity runs continue appearing, but now in the opposite direction. Price breaks a support level, that level becomes resistance, a retracement occurs, price briefly moves above that level, then closes back below. This forms a bearish liquidity run, giving continuation to the downtrend. It happens repeatedly as the market continues to create lower highs and lower lows. So here's the simple but powerful takeaway. Liquidity sweeps appear during accumulation and distribution. They are institutional reversal patterns. Liquidity runs appear during uptrends and downtrends. They are institutional continuation patterns. Once you understand how Dow theory and Wyckoff phases drive these liquidity behaviors, you can anticipate whether the next move is likely to reverse or continue and trade with institutional confidence. Now let's move to liquidity runs. What they look like, how to identify them, and how to trade them with confidence. To trade liquidity runs effectively, you first need to understand trending market structure, because liquidity runs happen inside trends, not during ranges. An uptrend is simply a sequence of higher highs and higher lows. Think of it as climbing a staircase. Each step higher shows that buyers remain in control. The reason is straightforward. Demand is greater than supply, buyers are willing to accept higher prices, and sellers don't have enough pressure to stop the advance. In an uptrend, price moves in two phases. Impulsive move, a strong push upward where buyers dominate. Retracement move, a temporary pullback as traders take profits before the next impulsive move begins. The impulsive move defines the trend. The retracement resets the price and provides opportunities for institutions to accumulate more positions. Understanding this rhythm is essential because liquidity runs happen during these retracement phases. A downtrend is the exact opposite. Price forms lower highs and lower lows, showing that sellers are consistently overpowering buyers. It's like walking down an escalator that keeps pulling you lower. Every attempt to rise is weaker than the last. A downtrend also has two key movements. Impulsive move, a strong drop driven by aggressive selling. Retracement move, a temporary rally before sellers take back control. The impulsive move pushes the market downward. The retracement attracts liquidity, allowing institutions to reload short positions. Just like in an uptrend, liquidity runs appear during these retracement phases, helping fuel continuation. The technique is very straightforward. We use support and resistance to locate areas where liquidity runs are likely to form. Let's start with this chart example. The market is clearly in a downtrend, creating a series of impulsive moves downward, each followed by a retracement. At the beginning of each retracement, price temporarily finds support, so we mark that support level. Once price breaks that support, it turns into resistance. This is where we expect institutions to push price back into the level before continuing the trend. Now watch what happens. Price retraces, violates the resistance, and then immediately closes back below it. This is a perfect example of a liquidity run, a continuation pattern that tells us sellers have stepped back in and the downtrend is ready for the next impulsive move. And as you can see, after the liquidity run forms, the market continues downward exactly as expected. Now let's look at a liquidity run during an uptrend, so you can clearly recognize this continuation pattern in both market directions. On this chart, the market is trending upward, forming strong impulsive bullish legs followed by retracements. At the beginning of each retracement, price reacts to a resistance level, so we mark that resistance on the chart. Once price breaks above that resistance, the level turns into support, and this is the area where liquidity run is most likely to appear. Here's what happens next. Price retraces back into this new support, briefly breaks below the level, and then closes back above it. This behavior is a textbook bullish liquidity run. It shows that institutions temporarily pushed price below support to collect liquidity before driving the market higher. Immediately after the liquidity run forms, price continues upward, creating another impulsive move and extending the uptrend with new higher highs and higher lows. Now that you know how to identify liquidity runs, let's move to liquidity sweeps. As we explained earlier, liquidity sweeps appear during accumulation or distribution phases. In other words, during range-bound markets. Let's look at a clear example. Price is in an uptrend, forming higher highs and higher lows, but eventually the market stops trending. You can see that price tried to push higher twice and failed both times. This tells us buyers are losing strength and the market is entering a distribution phase. During this range, we simply draw the resistance zone at the top and the support zone at the bottom. Don't stress about whether the range is accumulation or distribution. All you need to do is mark the boundaries and wait for a clean liquidity sweep. Now look at what happens. Price breaks above the resistance zone and then closes back inside the range. This is a textbook institutional trap, a liquidity sweep designed to catch breakout traders on the wrong side. Right after the sweep, price reverses, and as you can see, the market moves downward exactly as expected. This is the power of understanding liquidity behavior inside ranges. You don't chase breakouts, you wait for sweeps. Now that you understand how institutions use liquidity sweeps and liquidity runs, let's apply everything on a real market example. This is the US dollar Japanese yen 5-minute chart. As you can see, the market is clearly trending down, forming a sequence of impulsive moves and retracement moves. Here is the first impulsive move, followed by a retracement, another impulsive move, another retracement, and then a new impulsive wave. Once we draw this support level, which later turns into resistance, everything becomes clear. Price retraces back, breaks above the new resistance, and then closes back below it. This is a textbook liquidity.